Hello everyone and welcome to your Glassnode Onchain 101, where today we're looking at the reserve risk oscillator, which is actually one of my favorite on-chain metrics simply because of how much on-chain HODLer mentality is baked into a single line. It really has a lot of the underlying concepts that we use in on-chain analysis baked into it, and therefore it provides a very interesting behavioral model as to what the HODLers are doing, both on the upside when they're exiting and on the downside when they start accumulating. So the reserve risk metric is this big picture cyclical oscillator. And what it's really trying to track is when the reward and the risk profile is in the favor of hodlers, i.e. at the end of bear markets when they're undertaking extreme accumulation, or when it's getting towards the end of bulls and they're actually liquidating a large portion of their coins into strength. So what we're going to look at today is an overview of reserve risk and how it's used. We're also going to start diving into the calculation method. How do we get there? How is reserve risk calculated and what are the different inputs that affect it? So we're going to look at things like calculating the value of coin days destroyed, which is trying to bring the amount of lifespan that's destroyed and spent back into the market into the price domain. We're going to look at the concept of HODLer opportunity cost and what that actually means in terms of accumulation or spending behaviors, and then how all of that distills down into the single line that is the reserve risk oscillator. So let's get into the analysis. So we're going to start at the very big picture, just so we can see what reserve risk looks like and what the general concept of it is. So we're here in Glassnode Studio, and what you can see is that reserve risk typically trades between these very high peaks where it's in the overvalued zone around market tops. We can see we had two of them in 2013, one of them in 2017. We didn't quite get there during 2021, and we can explore that a little bit more as we get into the component section of this. You can also see that it pulls down into these low undervalued zones, these green zones, and interestingly, it seems to trade down here for quite some time. You can see that it picks up the back half of the bear market in 2014, all of the capitulation zone in 2015, and actually captures the vast majority of the 2016-17 bull run. So it almost picks up the first half of the bull before it really accelerates into the blow off top. We can see here in the 2018 bear that it essentially picked up the capitulation zone as being undervalued. 2019 poked its head above, but was hauled back down into that zone. And you can see that whilst price was more or less sideways on a macro scale in 2019, and again in 2018, we had a floor price of around $6,000. The market traded sideways. Note how reserve risk hauled this metric to the downside. It's interesting that it's almost like it has a form of gravity. It's being pulled down into the accumulation zone or into this undervalued zone, and it really remained there almost until we broke the previous cycle's all-time high. So you can see that there's a gravity that's pulling this metric down during bearish periods, but also note the speed and how quickly it rallies up into the all-time highs. So this is the dynamic that we're going to explore in a little bit more detail on how this metric's constructed and why in this particular instance we do get this very long and slow accumulation bottoms and a very rapid and reflexive rally to the upside. And note that reserve risk is on a log scale, so every point that it's moving up is a factor of 10 rather than in linear scale. So you can see it really does move to the upside very quickly and spends long times in the downside. And relevant to our current market structure, even though we set an additional all-time high here in October and November, note that reserve risk was much lower. And again, it's being hauled back down into this accumulation zone. And we're going to explore these mechanics actually using the Workbench tool. So here we are in Glassnode Workbench, which is our tool that we can use to create, compare, and contrast different metrics to really dive into the weeds and find out what's going on with each of these particular inputs. So you'll find this particular metric reserve risk components underneath our presets for market indicators. You'll find it here termed reserve risk components, where it really breaks down all the different puzzle pieces that go into constructing the reserve risk metric. So let's start with what we have shown here, which is price M1 in our gray market to the left-hand axis and supply adjusted coin days destroyed in the blue. So let's start with what coin days destroyed are. When we have a coin in the coin supply, each 1 BTC will accumulate 1 coin day per day. 2 BTC will accumulate 2 coin days, and half a Bitcoin will accumulate half a coin day. So it's a measure of lifespan, how long a coin has been unmoved or unspent in an investor's wallet. Now, we typically see coin day destruction, which is when that coin is spent, the lifespan is destroyed, and it starts reaccumulating. So we see large amounts of coin day destruction in bull markets. We can see here in 2017, in 2013, again in 2019, and then in 2020 and 2021. And this is when those hodlers who have older coins and they've accumulated during the bear market start selling into strength. They're essentially looking at the current price and saying, I'm now going to liquidate my coins, and therefore more demand needs to come in and soak those coins up. Now, conversely, during a bear market, we have a much smaller amount of coin day destruction. It shows that more of those coins are getting sucked out of the supply into investor cold storage, where they start to actually accumulate coin days. We're not seeing that selling of those 1 year and 2 year old coins. We're generally seeing younger coins being pulled off the market and going into cold storage. Now, we can bring coin day destruction into the price space by multiplying it by price, and thus we get the value of coin days destroyed. Now, that's what this orange chart is showing, and the way to think about this is the actual amount of value that hodlers are liquidating. They're essentially spending their coins and taking some amount of profit or loss out of the market. It's the spending behavior that is therefore saying the current price is sufficient to motivate me to spend my coins. Now, there's a couple of observations here. We can see that during the blow-off tops 2013 and 17, note how the orange curve starts to overlap with the price curve. So the way to think about this, that price is the incentive to sell and the actual sell side is matching the incentive. So hodlers are seeing, I am going to spend my older coins because the current price is enough to get those coins out of my cold storage. I think that it's a fair price and I'm going to therefore sell my coins. Now, conversely, during a bear market, note how there's more white space. These two charts separate. The incentive to sell is not enough to bring those coins out of cold storage. This is because hodlers believe that Bitcoin is going to be worth more in the future. And even though the price back here in 2015 was $230, $250, the amount of spending was much, much lower. So they're choosing to keep those coins in their wallet and not spending them. So it's showing this level of conviction and strength within the market. Now, we can see that value of coin days destroyed is quite noisy. There's lots of daily noise and it moves around quite a bit. So what we're going to put on now is the median value of coin days destroyed. So we're just taking a running median that essentially smooths out and gives us kind of the center line or the average typical price. Now, what we can see is that much more clearly, we get the median value of coin days destroyed, which is the amount of spending, starts to match up with the incentive to sell, which is the price, particularly during the late stage of bull markets. We saw this again in 2021 as we pulled into the January peak. And we can see it again in 2013 in both of these peaks where the median value of coin days destroyed matched up with the actual incentive to sell. So the price was sufficient to bring those coins out of hodler wallets and their spending matched the actual incentive. Now, the flip side of that is during bear markets. Note this wide separation of these two values. You can see it again in the 2018 and 19 bear phase, and then we can see it after the top here in May. We saw another opening up, a widening up of these two metrics. Now, this is suggesting that even though the incentive to sell at the current price is up here around 38,000 and back here it was 69,000, there was some increase in spending, but generally speaking, hodlers were actually keeping the coins in their wallets. There's less spending or there's higher conviction in the market. And the gap between the incentive to sell and the actual selling, you can think about this as almost the opportunity cost. It's the amount of dollars that hodlers decided to leave on the table. They could have taken profits at any point during this market cycle, but they chose not to because they believed that Bitcoin was worth more than the current price. And this is how we construct the HODL Bank. So HODL Bank is actually the denominator of the reserve risk metric, and it will trend higher and it will get larger when there's more hodling going on. So being in the denominator of reserve risk, when there's more hodling and there's more opportunity cost that hodlers are choosing not to sell, then you're going to get an increasing denominator, and that's going to pull down the reserve risk metric, which is what we saw before, that during these bearish markets, reserve risk got pulled down into the green zone. Now, conversely, note during the 2017 top and here again in the 2021 top, we started to get this flattening out. HODL Bank stopped moving as much because we're getting that closing up. There's less opportunity cost. The actual sell side is matching up with the offered price by the market. So during that period of time, the HODL bank in the denominator increases much, much less. And therefore, we get that acceleration into the top. The spending is matching the actual price. And therefore, we're seeing more coins come back into circulation. And we get this very reflexive move of reserve risk into that top. So now we can actually add in reserve risk, and we've got our bounds. And what we can see is that during periods where we have this matching up of the amount of sell side with the incentive to sell, you can see that reserve risk rallies into the top. And you can see that this is a very reflexive maneuver. And then likewise, during these more bearish periods when the gap between the incentive to sell and the actual selling is much less, even though price trades somewhat sideways on a macro scale, 2018 is a good example, sideways price with a floor at 6,000, but reserve risk is being pulled down. This increasing opportunity cost that hodlers are choosing not to sell is creating this downdraft and pulling reserve risk into this macro low zone. So what we're really seeing here is that reserve risk will weight down when there's more accumulation, when the hodler behavior is favorable for price, noting that it can take some time to actually generate these macro bottoms, but that's why it really pulls down price during the late stage of the bear and even keeps it in the undervalued zone all the way into the almost around the middle of the bull before we get that euphoric push up to higher levels. So when we look at our current market cycle, we can see that previously we broke well and truly above the overvalued zone as the spending pressure was sustained for a number of weeks, number of months, as the overall price pushed higher, more and more coins came back into circulation, and eventually the bull had to be exhausted. Now, what we saw during our 2020 and 2021 bull is that there was a peak in overall hodler spending, but at no point did it really sustain that for a long period of time. And we really saw that they went back into that hodling accumulation behavior much, much sooner, which started to apply this downwards force and pull the reserve risk metric back down into the undervalued zone. So it's quite an interesting dynamic that even though we saw much, much higher prices, the overall hodler base after that May sell-off really moved back into accumulation and hodling mode, which is quite an interesting dynamic. It's certainly nothing that we've seen in any of these previous market cycles. If anything, it looks a little bit more like this 2013 top where we had an initial bout of sell side, which then opened back up into a period of dormancy and hodlers not realizing that opportunity cost. Now, granted, we haven't had the follow-on rally. What we've essentially seen is a pullback into this more bearish trend. So we've really pulled this reserve risk metric back down into the undervalued zone, and in past cycles it has remained there for a somewhat extended period of time. So that tries to set the expectations for how this metric actually functions. So overall, the reserve risk metric is a very big picture and macro oscillator, and it's trying to capture that hodler conviction, the spending behavior, and really trying to identify when a hodler is choosing not to sell and leaving that opportunity cost on the table. As a result of this, it generally creates very, very long bottoming patterns during accumulation periods, and they can last a number of months and sometimes even years as those hodlers just soak up the supply. And we generally have to use reserve risk alongside a number of other metrics that really speak to the demand side. But what we also see is that during those euphoric peaks when the market is very excited, lots of those hodlers start liquidating those coins and spending. They believe that the current price is enough to bring their coins out of cold storage. And we see that increase in coin day destruction. That's when we start to signal these very, very reflexive blow off tops that the reserve risk is actually quite good at picking up, because it's showing that the amount of sell side is in fact matching the current price. So essentially it's enough incentive to bring those coins out of cold storage. So hopefully you enjoyed this Onchain 101, doing more of these deep dives into how these metrics are constructed and what to pay attention to. Do let us know what your favorite metrics are and what you would like us to cover in the future. Be sure to give us a rate, a review, and a subscribe, and we look forward to seeing you in the next one. Cheers.